In the stock and investment market, there's a saying that goes, a good buyer is a student, but a good seller is a master. So, in real trading practice, how do we tell if a rally has peaked and it's time to sell? How can we identify a sell signal from the market? In this video, we will share a practical technique for selling. At the end of an uptrend, you may see a specific candlestick pattern appear. What kind of pattern? Like this one. This pattern consists of just two simple candlesticks. One is bullish, the other is bearish. This candlestick formation has a vivid nickname. What is it? It's called torrential rain. So, what is this torrential rain pattern? What are its conditions? It's actually simple. First, the bullish candle shows a clear uptrend in the market. It reflects strong buying momentum. Then the next candle opens lower, right from the start. It gaps down, but to where exactly? It opens inside the body of the first candle. And after opening, it keeps falling. Clearly, the bulls put up no fight. The bears drive prices straight through the bulls' territory. And importantly, they break below the low of the first candle. That confirms it. The bulls are defeated. At this point, the bears take control with full dominance. For the second bearish candle, its opening price must be below the first bullish candle's close. That's a key condition for this pattern. The second candle must open below the closing price of the first bullish candle and then drop below its lowest point. It must break that low to confirm the pattern. Only then can we say the bears have taken over. The bulls have been defeated, and the bears at this point are fully in control. Also, the second candle's closing price must be below the first candle's opening price. That closing price must fall below the open of the first bullish candle. That's essential for confirmation. Look at the second candle here. This is its closing price, right? Correct? It must be lower than the opening price of the first bullish candle. That is its lowest open level. This spot right here. Only when all these conditions are met does the pattern become valid. So during an uptrend, if this candle pattern appears, there's a high chance the market has reached a short-term top. It signals a good opportunity to sell, a solid signal to exit. So what's the key to this candle pattern? It must appear during an uptrend. It has to form in a rising market. If it shows up in a downtrend or low area, this kind of pattern like pouring rain doesn't count. Then it's invalid. Only when it forms in an uptrend does it count as topping signal. That's when the pouring rain pattern matters. That's a key point. What else matters here? The longer the second bearish candle spot is, the stronger the drop, the stronger the sell signal. The steeper the fall, the clearer the warning. And if during this drop there's a spike in volume, especially a significant increase, that confirms a higher chance of a reversal taking place. So here comes the question, what's the logic behind this reversal signal? Why does this pattern work? Why does a pattern like pouring rain signal a market top? Why does it often mark a turning point? Why is the reversal probability high? Why is it seen as a solid sell signal? Let's explore the reasoning behind it. We need to know not just the what, but the why. Let's break it down together. What makes this pattern valid? So why does this pattern work? It's because the first bullish candle shows that the market is in an uptrend, with bulls still pushing the price higher. At this point, market sentiment remains optimistic, but the second bearish candle suddenly shows a surge from the bears, gapping down and falling, breaking below the key support of the first candle, which is its low. That key support lies at its opening price. The opening of the first bullish candle is a critical support level. It's essential that the second candle breaks below that opening level and even falls below the previous low. A move this strong and with steep losses makes the reversal signal more powerful. The sharper the drop, the stronger the signal. What does this mean? It means the bears suddenly stepped in and suppressed the prices from the open. That shows both have lost the strength at this level. Selling pressure continues throughout the session and the price keeps falling. Once it breaks the key support of the first candle, that opening level, and then breaks the previous low, we can confirm that bears are now in control. They've taken over and the reversal signal has clearly formed. Of course, in actual trading, we can combine this pattern with other technical tools to improve accuracy. For example, if at the same time the price also breaks below key moving averages and the MACD indicator turns downward with a clear bearish crossover, then bears are in control. So, in this kind of setup, combined with strong technical signals, the bearish signal becomes more reliable. Its confirmation strength is even higher. When you see this kind of setup, it's usually a good time to sell. And when you combine it with indicators, you improve your confidence even further. Of course, if this downpour pattern appears near a key resistance level, a significant downpour candlestick right around a major resistance zone or a supply area, then the confirmation becomes even stronger. As you can see here, this setup happened right around a key resistance zone, which makes the reversal signal even more convincing. Looking at the broader market index over the past 2 days, specifically on June 12th and June 13th, we also saw a classic downpour pattern right at the tail end of the uptrend. And here's what happened. On this particular day, the first candle was bullish, then the second candle opened lower, a sharp gap down, well below the first candle's close. In fact, significantly lower. It even broke the low of that bullish candle, hitting a new intraday low. So this was a strong bearish reversal, a strong warning signal, and it exerted a lot of pressure on the market because this pattern appeared at the top of the move right when the rally was nearing exhaustion. On top of that, the MACD also formed a bearish crossover at the exact same time. The second candle also broke below several key moving averages, breaking major technical supports. So, with this downpour pattern, this bearish candlestick formation, the pressure on the market is quite heavy, and it signals a potential top. Of course, it doesn't mean that every time we see this pattern, especially at the end of an uptrend, it guarantees a reversal. It's not a 100% certainty, but the odds are significantly higher. When a downpour pattern shows up, it often signals a strong chance of trend reversal, especially if it appears around a major resistance level. That area right here acts as a resistance zone. This area clearly has overhead pressure, which confirms the pattern further. Add to that the MACD at this point, we also see a clear bearish crossover. The bearish momentum is starting to grow and picking up speed. So at this level, downward pressure on the market is heavy, which makes further upside potential much more limited. So in real trading scenarios, we must pay close attention when this signal appears. If you're unsure, even after catching a solid uptrend, whether to keep holding or start selling, then you need to look at what the market is signaling. That's how you stay in sync with the trend. You've ridden an uptrend, so when is the right time to exit? Wait for a clear signal from the market. And that signal could be something like this. During the uptrend, you see a downpour pattern form on the chart, a candlestick pattern like this. At that moment, you need to stay alert. It could signal a trend reversal. As a sell signal, its probability is relatively high, especially when it coincides with a major resistance level. Then this candlestick pattern also broke below the moving average system, and the MACD indicator showed a bearish crossover. With multiple indicators aligning, the reversal signal becomes more reliable. The confirmation becomes stronger. This is what we're sharing in this video, a simple method to spot potential sell points in real trades. This strategy is based on a simple candlestick pattern. In fact, the setup only involves two candles, just two candles, right? But behind it is a solid underlying logic. During the uptrend, it might seem like the market is still strong, the trend looks intact, but when the momentum is weakening, you often get a final push. It may seem strong, but the rally lacks volume and lacks real momentum to carry on. That means follow through buying is weakening. Momentum fades, and once a sharp gap down hits, especially a plunge at the open, what does that suggest? It means big players might be exiting because retail traders piled in during the uptrend, and the smart money senses the market is losing steam, so they pull out early, causing the stock to gap down and fall sharply. And if that decline is steep, the drop becomes more brutal. This shows that the bullish momentum is nearly exhausted. Retail investors are getting nervous. If you don't exit, you might get stuck in the pullback. At that point, more people start selling and the trend reverses. That's how it begins. So, this candlestick pattern, even though it's very simple with just two candles, it has a solid underlying logic. That's why it holds up and the success rate is fairly high. If you have any questions about this pattern, feel free to leave a comment below. We can discuss it together.